Right now, the US economy feels like it has a complete split personality. I mean, on one hand, you and I, we're feeling more worried than we have in years. But on the other hand, businesses are acting like the party's just getting started. So, what is the real story here? Let's dive in and unpack these numbers. All right, so first up, let's just talk about how people are feeling. The latest consumer confidence number just came in, and wow, it's 84.5. Now, to put that into perspective for you, that is the lowest it has been since 2014. Seriously, let that sink in for a second. People are feeling worse about the economy today than they did in the absolute thick of the pandemic. That's saying something. And look, this wasn't some slow, gradual decline. No. Confidence just fell off a cliff. It dropped almost 10 full points in just 1 month. That is a massive, sudden swing toward pessimism, and it's happening pretty much everywhere. So, you might be thinking, okay, maybe everyone's just in a bad mood, but it's more than that. This feeling is actually backed up by a really key indicator. It's called the expectations index. And get this, it has been flashing a recession warning for 12 straight months. Historically speaking, when this thing stays this low for this long, it's like a giant bright red warning light on the economy's dashboard. So what's really driving all this anxiety? Well, it pretty much boils down to one thing: jobs. A clear majority of people, we're talking 55%, are now saying it's tough out there to find a job. And that's not just a statistic, right? That's a real, tangible fear that totally explains why so many folks are on edge about what's coming next. Okay, but this is where the story gets really weird. It takes a complete U-turn. Because while consumers are hunkering down and bracing for the worst, American businesses and manufacturers, they are singing a completely different tune. Just look at this number. While regular people are cutting back, orders for what we call durable goods, the big expensive stuff like heavy machinery, appliances, that kind of thing, they surged by a massive 5.3%. That didn't just beat expectations, it completely blew them out of the water. And let me tell you, companies just do not make these kinds of huge investments unless they feel really, really good about what's coming down the pike. And this chart right here really shows you just how wild that turnaround was. I mean, after falling the month before, these orders didn't just bounce back a little bit, they exploded. This is pointing to some serious strength and heavy-duty investment right in the heart of the US manufacturing sector. So you gotta ask, where is all this money coming from? Well, a huge chunk of it is from transportation. We're talking a nearly 100% jump in aircraft orders. But what's maybe even more important is this thing called core capital goods. That's basically all the machinery and tech that businesses buy to expand and get better. And that has gone up for the 5th month in a row. The takeaway is crystal clear. Businesses are putting their money where their mouth is and investing for growth. So here we are. This is the central puzzle, right? You've got two completely competing narratives. On one side, you have us, the consumers. We're seeing recession signals, we're worried about our jobs, so naturally we're pulling back on spending. But on the other side, you've got businesses looking at record orders, investing a ton of money, and this is a huge point, they are not letting their employees go. And speaking of jobs, check this out. The number of people filing for unemployment for the first time is still hovering near historic lows. This just adds more fuel to the business is strong side of the story. Companies are not laying people off. Economists have a name for this. They call it a low hire, low fire market. Basically, businesses are thinking, I'd rather keep the great people I have right now than risk having to find new ones later. All right, so this whole situation brings us to the one group that has to try and make sense of this crazy puzzle and make decisions that, let's be honest, affect every single one of us. And that is, of course, the Federal Reserve. So what's their move? Well, at their very first meeting of the year, they hit the pause button. They'd been cutting interest rates, to make borrowing cheaper and spur things on. But now they've decided to just hold everything steady. Why? Because they're looking at all that business strength and essentially tapping the brakes. They're not so sure the economy needs more gas right now. And just as a quick refresher for everybody, the federal funds rate, think of it as the foundation for pretty much every other interest rate out there. It trickles down and affects what you pay for your mortgage, your car loan, your credit card, you name it. So when the Fed says pause, it's their way of saying, we're not quite ready to make borrowing any cheaper just yet. But here's the thing, this decision wasn't unanimous, not by a long shot. As you can see here, 2 members of the committee actually voted to go ahead and cut rates anyway. And that split right there, it tells you everything you need to know.
Even the top economic minds in the country can't agree on which story to follow, the fearful consumer or the booming business.
So, why all the caution? I mean, why not just cut REITs and give the worried consumer a little breathing room? Well, the answer is the same one we've been hearing for a while now, that stubborn, lingering shadow of inflation. Right around the same time the Fed was having its meeting, a new report on wholesale prices dropped. This is basically what businesses pay each other for goods and services. And boy, did it come in hot. Way hotter than anyone expected. It basically threw a giant wrench right into the middle of their plans. And this chart really puts that surprise into perspective. The experts, the analysts, they were predicting a tiny little 0.2% rise in prices. But the actual number? It was more than double that. This is precisely the kind of data that makes the Fed get really nervous about cutting rates and potentially letting inflation run wild again. And when you dig into the numbers a bit, you see that this inflation spike isn't really coming from physical goods. Those prices were actually flat. No, it's all coming from the services side of the economy, which is notoriously stickier and much harder to bring down. Some analysts are pointing fingers here, suggesting this is where companies are finally passing on higher tariff costs to their customers. Okay, so let's pull all these different threads together. What does this tale of two economies actually look like when you lay it all out side by side? I think this table just sums up the whole conflict perfectly. You've got the consumer economy over here, where morale is in the basement, recession indicators are blinking, and the general feeling is that jobs are hard to come by. And then you have the business economy over here, confident, posting massive orders, investing for the future, and most importantly, keeping people employed. And the results of all this, it's this major tension pulling the U.S. economy in two different directions. You have a really worried consumer base clashing head-on with a surprisingly strong business sector. And who's stuck in the middle? The Fed, just trying to walk this incredibly narrow tightrope, doing its best not to tip things over one way or the other. So, what's next? Well, pretty much all eyes are on the Federal Reserve. Now, they do meet again in March, but if you look at what the financial markets are predicting, nobody really expects a rate cut until June, at the absolute earliest. So yeah, those are going to be the key dates to circle on your calendar. And that leaves us with the one huge question for 2026. Which story is going to win out? Will the resilience we're seeing from businesses be enough to pull the worried consumer up? Or will all that consumer fear eventually drag the whole economy down with it? The answer to that question is really going to define the rest of the year.